Good Thursday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you and a pleasure to be with my co-hosts. I'm going to enjoy them while I have them. We have some split schedules the boys have to do today, but we've got them here for a while. How you doing, Dwight Millard of Highlands Mortgage?
I'm doing fantastic, John, and I want to give you a shout out because you've always said all these years family first. So
Family first.
when you take it while you can, right? Because before
Well,
it's
tell the
gone,
audience
right?
what you're talking about.
Well, I got a last soccer game. I've always said last soccer game, so be careful, Corey. It's never your last soccer game. There's always more, but I appreciate your generosity, and we're you run out of runway real sweet.
Yes,
soon
you
on
do.
That, so.
Yes, you do. You had an opportunity to extend that runway, and you got to take advantage of it. And we wish her the best on her soccer game. And
Thank you.
yeah, absolutely. So Dwight's going to be leaving us at the bottom of the hour. Mr. Corey Edgeved, Realty. Speaking of soccer, boy, the soccer's is consuming the show. You're leaving to head over the hills. You do each and every Thursday, so you'll be leaving the last segment of the show.
Yeah, we figured you have enough experience now, John. We're okay leaving.
Wait a minute! I just figured this out. You guys are doing a payback for when I had to bail on you with my attack the other day. That's what it is.
Dwight and I are actually meeting at a bar to have some.
Yeah.
Right, exactly. You're gonna listen to the show and make fun of me.
Yeah. John doesn't sound right.
Yeah, something doesn't sound right.
I'll already have a table.
Call in with a bunch of questions.
Yeah.
This is Frank from Appalachia.
Yeah. Well, that's not a bad idea, Corey.
I'm prepared. Just lay it on me. Well, speaking of being prepared, man, oh man, what a day it was today. We're gonna prepare you for what I'm about to tell you. It was a very, very tough day today. As the boys and I were chatting off the air before the show started. Pretty simple. There was not one specific bad news story or one economic report that was bad. It was one of these days. I hate saying it. It sounds so unprofessional, but it's the facts. It was one of these days that it was a rotation out of a lot of areas, AI, tech specifically, and financials, and into the likes of a Walmart or a Coca-Cola or these consumer related stocks, and they just bailed on everything. And it was a tough day today. Percentage wise, not all that bad. But yeah, if you haven't heard, I'll tell you in a second what we did today.
So, John, I have a question for you. A quick question,
Sure.
because this is. So I said, a flight to qual. You said no, it's a rotation. So I haven't heard that word before. So.
Yeah, and I'll explain it, Dwight. That's I'm glad you brought that up. Yeah, and the markets go through this. The markets will get hot and cold in certain sectors of the market. So, for example, we have 11 sectors of the S&P 500. They will rotate in and out of those areas. I know you guys have heard me say this a million times, as the audience has. You literally wake up one day and what area maybe just had been on fire, like AI or certain areas of tech. You wake up and maybe you get a downgrade or two in one of the major names in that area, or maybe there was an economic report that did not favor like today. I just got to jump into this. The truckers, not a sector that we talk a lot about. Transportation is very, very important. But you had Sean Duffy, our transportation secretary, come out today and said, no more. They basically implemented a bill, which Lord knows they should have done this a long time ago, where if you are, essentially illegal in this country, you cannot have a commercial truck driving license. I mean, that's the way it should have been. I can't believe. I mean, I'll tell you, you guys know this, and I don't know if some of the audience, I do have a Class A commercial truck driving license to be able to haul hay, for our ranch and things like that. So I went out and I got that a couple of years ago. And I remember I went to a Saturday truck driving school down in Sacramento. And you're at this school, and the way the school works, it was like a cram course. It was like 4 hours before your DMV test. So your DMV test consists of, you do what's called a pre-trip, which is where you got to go through and show the DMV instructor that you know everything in the cab, everything underneath the hood, everything underneath the tractor, everything on your trailers. You do an air brake test. You do all these things. Then if you pass that, then you go out and you do a driving test. And I'm sitting down there, guys, at this DMV in Sacramento. Again, this was, 5-6 years ago. And, there were, I won't say what nationality, but there were a lot of people that basically could not speak English. They're just one after the other. And I'm thinking, how in the world can this be? I mean, it's a tough test. That's on top of you've already taken your written test, a week or so before that. And so I was very surprised as I learned about the trucking industry, how long this has been going on. And now, of course, the president said, no more of this. There's way too many accidents of guys that can't, literally read the signs that are on the highways. So I was thrilled to see this, but my goodness, this group, it's just one of the stories of today. This group just got hammered. C.H. Robinson Worldwide down $29.30, 14.92% loss. Landstar down $26.20. About a 16% decline. JB Hunt down almost $12, 5.16. Werner Enterprises down 5.3%. On and on and on. This group, and this is kind of the reason I'm bringing this up. This, Dwight, is that rotation, right? You start seeing things like transportation sector has just been doing phenomenal up until about the last week or so. We started to see rotation. Well, this was the dagger in the heart today when this news came out of the White House. And that group came down. And like I said, a whole bunch of others did that I'll explain in a moment. But let's jump into real quickly what we're going to be talking about today. We're going to call today's show the Consumer Checkup. What's your financial health and what does it mean for real estate? Guys, I came across a story this morning. I'm not going to read it. I'm not going to bore everybody, but the gist of the story was it's, again, very similar to what we've been saying. The health of the consumer is not great right now. This Wall Street Journal article that I'm referring to was talking about the credit counseling services that normally cater to middle class, maybe a little bit below middle class. And they said, we are seeing the upper class now coming in needing the credit counseling services. We're seeing what used to be an average of $30,000 in credit card debt. We're now seeing an average of $70,000 in credit card debt. And it was again a very, very good article, but it opened my eyes and I said, okay, let's how does this relate to the world of real estate? Because obviously you got to have money, you've got to have low debt and so on and so forth. So that's where I want to bring this in. So the boys have put together some really, really good bullet points that we're going to be talking about in relation to the health of you, the consumer, and how that compares to the real estate side. Corey, real quickly, spot on topic.
Absolutely. And especially, we'll get into it a little bit after today's housing numbers, which might have a little bit to do with people getting freaked out. But we've been talking about this for at least 3 years. The cost of living, the insurance, the medical insurance, everything it costs to just live. I can't remember the exact number, but I thought they said here in Reno Sparks, it took a combined income of $250,000 to afford the average house. Like, you have to be kidding me. This is
right.
crazy.
A state that has what are we, 56,000 median now, I think?
Yeah, it's nuts.
So even two incomes, at 60,000.
You need four.
Yeah, you need four. Yeah, you're right, Dwight. And hence what you've always said, Dwight, right? The co-signers and so on and so forth.
Yeah, and so it's very timely because people are going through it. And I thought I heard, it was either this week or last week, that credit card debt or revolving debt was the highest ever again. I mean, it seems to be beating itself.
Yes.
So I think a lot of people are feeling this. A lot of people.
Well, Dwight, you haven't touched on this in a while, but to Corey's point, he just jarred something in my memory. Remember, we've been talking a lot last year. I don't think we've even mentioned it this year. The $1.3 trillion in student loan debts that pretty much are due now, right? They're coming after the borrower now, and how that weighs on obviously a person's budget, their debt to income, and so on and so forth.
Well, John, and if you remember, in the Biden administration, they canceled it, then they froze them, all that. Well, then all of a sudden, nobody knew. They brought it back online. There's a lot of people out there, John, that have a student loan derogatory as of last year when they brought it back online.
How bad of a hit is that to
100
to
points. It was 100 points. I had two borrowers, John. Two borrowers, one at 730, one at 750. Actually, it was even more than 100. So, and it was really unfortunate. None of them knew. I've got somebody in the family that same thing. You just thought you were on this. You remember they kind of just paused them. You remember the repayment?
Yes. Oh yeah. There was so much.
They never notified anybody. They started them up again. Everybody was late. Yeah, and there's a lot of audience, I'm sure, out there that know people that this happened to. Yeah.
Or themselves. Yeah. Dwight, did they bring that out when it hit the credit bureau of the borrower? Did it come out as a 90+ late, or did they just show it
rolling?
They did. So they skipped right from the 30.
By the time you knew it was by the time I think you were supposed to start in August or whatever it was last year, and by the time you knew that you were behind, it was already 60, 90 days past due. And it's tough because I got the same two borrowers. The one said that they were told that they were going to eliminate him. They never did. So, and then the other one just caught up real quick and is slowly getting It was
And the
awful.
government, from what I understand, I think they've become a little bit more lenient here in the last month, and I don't remember exactly what makes me think that, but I know, like you said, last year predominantly when this repay back program started, they're like, okay, we've given you a chance. You've gone years without making these payments.
Yeah.
We're going to garnish your wages. We're going to hold back your tax refund, right? They're going to do everything which is pretty much anything the government wants to do, it can do to get their money back. It's
Well,
like,
I'm not,
man,
and I wasn't opposed to that, John, because you're absolutely right. It's the manner in which all of a sudden no communication. It was so confusing through the Biden administration. Did my loan get forgiven?
Yes.
What is my story? And then all of a sudden, with little notification, at least from these few borrowers I've talked to, it just all of a sudden happened. And maybe at least they could go back maybe and forgive, do a one-time exception, forgiveness of the late or something. That's a problem.
But to Corey's point, it is the sign of the consumer.
Yep.
This article also reflected that I forget the exact little saying that it said, but it's no longer what I want or what I want in life as far as my discretionary spending. It's more, what do I need, right? I need shelter, I need gasoline in my car, I need some food on the table. And after that, there's not a lot left over for most people, for a lot of people, I shouldn't say. So, yeah, it's going to be interesting to get your guys' perspective, and I'll throw my 2 cents in also, of course. All right, let's turn it over to Kristen Snow, Right Now Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on Newstalk 780 KOH with Corey Edge of Edge Realty and, of course, Dwight Millard of Highlands Mortgage. All right, Dwight's got to get out of here, so we're going to get hustling real quick. Let me just tell you what happened here in the market as far as the averages, what they did, and then after we come back from the bottom of the hour break, Corey and I will go into a few more details, then get into our real estate topic, the financial health of you, the consumer, and what it means for real estate. So we lost 669 on the Dow, 1.34% to a close of 49,451. NASDAQ down 469, 2.04%. And the S&P lost 109, 1.57%. The worst percentage-wise, second worst percentage-wise, the Russell 2000 down 2.01%. The NASDAQ was the worst. But guys, again, right around the board, it was, and Corey and I will talk about this, the real estate sector got hit real hard after Elon Musk came out and said, there's really, I don't forget what he said, Corey, 10, 20 years, there's really not going to be any need for office buildings because there's not going to be anybody in there. It's going to all be AI chatbots and things. So there's no need. So we saw, CBRE, tank, and I mean, just, right on down the lines. Yeah, it's just, like I said, it was one of those days. All right. So we'll come back to a little bit more market detail, but Dwight's got to run here in a few minutes. So Dwight, I want to get you in on these talking points about the health of the consumer. Yeah. Let's talk a little bit. I want you to combine kind of our second and our third point, but here's the first one. The home equity, it's the consumer safety net. So with the health of the consumer fragile, how's that going to play out?
Yeah, so John, we've been talking about this for a long time, but if you're thinking about tapping into some equity, so if you're upside down, you don't have much relief there. But a lot of these HELOC companies will go up to 90% combined loan to values, depending on where your first is sitting at. So that gives you a little bit of breathing room. John, you have been a big advocate over the years of people taking these out and just sitting on them, Yes. And this may be a time where people could use a little bit of relief. And it does take, as this says, it's a pressure valve. So it does help a little bit there. You're treating a long-term asset like a short-term ATM machine. So
yeah,
be
that's
careful.
A good analogy. Yeah.
We have seen people take it over the years, cash out and go do crazy things with it rather than take care of, student loan debts and things that we've talked about. So if you have a real need, explore it because there's not much cost to getting out. It's just now with the compression of the values, I don't know how much you can actually get out, but get out the max you can get out. So you've got a lot of clients, John, that we've helped over the years establish lines of credits.
And I want to be real clear. What Dwight's referring to is when he said that I'm a big advocate. What we're talking about is, again, even if you have, and this always blows clients away, Dwight knows this, they've got a free and clear home, right? They've accomplished one of the greatest dreams for most people. And I'm coming back to them and going, okay, now I want you to go get a loan against that. They're like, what are you talking about? And this is what we're talking about, home equity line of credit, just as an emergency. Again, it costs you almost nothing to have that. But I can't tell you the stories I could share with you if we had the time of clients that thank me years later when a major health event happened, or maybe they had to help out a family member or some major expense, and they're retired. And as Dwight will attest to, we need to do a show on that, Dwight, how to get a loan when you're a retiree, because that's getting harder and harder, I see.
Yeah.
So that's what we mean about, if you don't need it, go get it. And it's like the old adage, right? Bank wants to lend to you when you don't need the money. Well, the time to get a HELOC is when you don't need it.
And John, not to get too crazy into it, and we can do another, but that's where the reverse mortgages come into. It's another, people don't really, they're confused because what I do is forward mortgages. This is a reverse that kind of pays you back over the equity
Great point.
built. So yeah, there's another way to do it, especially if you're in the older years, you have mom and dad still living in their house or something. It's definitely at least a flyby.
Absolutely. All right, let's go to our second point for you, Dwight, the mortgage reality check. What do you mean by this?
Well, so we've been sitting, so right now, but we talked
what do we
about the
do
other
today?
day, we've got lots of rates that are under 3%, right? I mean, lots of buyers. But now with the higher interest rates, which is putting the compression on, but these new buyers coming in, they look at mom and dad or their older brother and sister bought a house and now they're coming in with the rates up. And as Corey mentioned earlier, the higher homeowners insurance, taxes are up. Everybody's trying to squeeze the dollar out. That's where the affordability shock has come in, and it's massive.
Powerful term.
It's a big spread between people who bought or refinanced back in 19, 20, 21 to where you're at today. They're still seeing their bumps up in their homeowners insurance premiums, but not like they're seeing coming out of the gate.
Let's talk about, in that same breath, Dwight, the underwriting, getting more difficult and the borrower quality. What are you seeing there?
So,
as a consumer?
yeah, well, what's interesting, John, is the jobs are becoming more difficult to track, right? I mean, meaning I've gone to a flex schedule, I've gone to and that it's very difficult for underwriting. But first and foremost, remember, everything goes through an automated underwriting system, and they're constantly adjusting the algorithms, right? They're tightening, and a lot of times it's more tightening than loosening. So, but you're seeing, they just did a scrub, I don't know, a month ago into the year or something. And if you've got a high loan to value and you've got a low credit score, it's getting tougher and tougher. And then when you get it, if you could get it to prove that, then you've got an actual underwriter that's going to cross-check everything and make sure. And there's some, there's flexibility and strains on these jobs.
What kind of mood are these underwriters in today? Are they very cautious? How'd you like that question? You didn't know I was throwing that one
mood,
out.
Yeah, hopefully my underwriters are listening. Right?
No.
No. The land of no. Yeah, no. They're cautious. They don't want buybacks. So there's a lot of chatter going around from different companies all around the country about be careful about buybacks, early payoffs, or early payment defaults, John. Those are we're seeing a few of those now. So yeah, to the bigger point, and you guys are right, Corey nailed it. The consumer's stretched. The consumer is stretched, and a house payment, you thought you were going to something that you can, ride the sunset on, and it's just getting tougher and tougher to maintain that.
Last question before I let you run. What would you say, if you went back in your memory bank, say for the last 12 months, what would you say is the average, all combined, PMI, everything, average payment that you're seeing with your borrowers?
Well, better than the average payment, John, is I think on a conventional loan, you're pushing about a 40, I'd say the average is probably about a 46 debt to income ratio on the backside. And on government, you're pushing probably 50%. So
I'm asking you, what is their actual payment? If you throw in PMI, everything. Yeah, what are you kind of looking at as far as an average?
3,500?
No kidding. Man, I thought you were going to say 25. No kidding.
3,500. The insurance premiums are insane. Corey's nailed it, and there have been zero talks that I can see of any reform coming down the line. Anything. I mean, and taxes are going up, John.
Yes.
These municipalities, these cities, we can get into but they're paying a lot of staff and different things. They got to get the money somewhere, and property taxes are good. Schools.
Corey, we're starting to just. I met a new friend through my son this weekend on Super Bowl, and he works for a major tech company. I won't say which one, and he was here because they're going to build a new data center out in Trick. Obviously, we already have some. There's many, many more coming. Could we see property taxes increase over time just because of these data centers?
Well, not to get into the weeds, but the data centers are in Story County. Story County doesn't necessarily allow residential, so that's what pushes everything back to us. And so the theory is, from the people that run the government, is the more we have, the better, because it'll up our tax base and we can accommodate more. But all they end up doing is for every dollar they get, they spend too. Okay, so in theory, if they had some fiscal management, or actually people that understood how all that stuff works, yes, it could equalize itself out, bring it down, understanding we don't need to give every single citizen every single benefit. Like, cut it a break here. But I don't think that's the way it's going to happen. Let's put it that
Yeah.
way.
Yeah, I heard
John,
when
but what's gone? Electric bills around those have gone up 3 times.
yeah, I
3 times.
was just going
Electric
to bring
bills
that
are
up. Well, I heard as I was waiting to do my closing report today with Jack, our producer, Waste Management, right? They bumped up the bill. It wasn't much, but $16, I think, right, Jack? I think you said it was like $16 a year or something like that. Again, 16 here, 20 there, power bill that's higher. Bottom line, it just all adds up. All right, my friend, God bless you. We wish you
Thank you,
great luck
guys.
on the soccer game with your daughter this afternoon or evening time. And Corey and I will take it from here.
Thank
So
you.
take care, and we're gonna, you bet, see you, buddy. And we'll turn it over to Jack Saban. Speaking of which, it's got news, traffic, and weather. Hey, Jack. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Corey Edge of Edge Realty. Once again, we're going to be talking about the consumer checkup, what your financial health means for the world of real estate. As I said earlier, the bad news of the day, we finished down 669 on the Dow. The NASDAQ lost 469, S&P down 108. I'll make it real simple, Corey, as far as what happened, because we had to jump into our topic with Dwight leaving. But like I said, it was really a day of rotation. It was a day that we woke up. Things weren't all that bad. Matter of fact, we had triple digit gains on the Dow futures right before they opened. NASDAQ was almost triple digit. Everything looked good. We had the initial claims come in at 530, showed the economy gained 220. Or let me rephrase that. We showed the initial claims for the week up 227,000. Estimates were 225,000. So that's about a normal number. So those are filing, for the first time unemployment benefit. Continuing claims rising. So what I was trying to say, 21,000 to 1.86 million. So we couldn't blame that. But then in your world, the housing starts for the month of January down 8.8%.
It should not be a surprise to anybody because we went over January data here locally, and typically what's happening here is happening everywhere. Why it's happening, I have no idea, but we seem to follow those same
Consumer
patterns.
slowdown.
I think it's consumer slowdown, and I think, and we'll get into some of this. I think homeowners are content. They're like, well,
Yes.
why
Yes.
would I ruin this? I got plenty of money in the market. It's doing fine. My house is great. It's a low payment. Why would I go do anything? I'm just gonna go on vacation, right? That's
Yep.
what I'll do.
Yep.
So.
Yep.
And I don't want to get on a soapbox, but they keep using the word crisis, and this is not a crisis.
No.
This is the furthest thing from a crisis.
Not even can't even define it as a correction yet, right? Meaning 10% decline.
Well, they're saying that you've got a real estate crisis because people can't afford it. Well, there's 50% of that ledger are the people that would have to bring the. So it's certainly not a crisis. A crisis is a war or cancer.
Yes.
I mean,
Yeah.
this is just.
9.
Yeah. That's crazy. It's not that bad.
Yeah. No, I hear you. Some of the big downdrafts today. Apple down $13.77, 5% loss, 261.73. Wasn't all bad news. Cisco was another big drag on the Dow, down $10.54. Good earnings number, but a little bit light in a couple of areas. About a 12.32% loss to $75. But like I said, it wasn't all that bad. Memory storage stocks did really good. SanDisk up $30.95. Micron up $3.63. Robinhood was under pressure today, down about $6.85. I talked to you about the truckers. That was another big area. But then again, Walmart, our standout today on the Dow at $4.87, 3.78%, 133.64. So why? Because the consumer is weakening and they're flowing their money into, that type of grocery store versus, some of the others that are a little bit more on the more expensive side. I'm not saying not better quality, but just a little bit more expensive. So that was the gist of it today. Oil prices down $1.72, $62.88 a barrel. Gold gave up $148.90, closed at $49.30 an ounce, and down 7 basis points on the 10-year at a yield of 4.1%. Okay, Corey, let's go back to our bullet points here that we want to touch on. Let's kind of start at the top of our list, which again, the consumer snapshot, strong or stressed in your opinion?
Stressed, and they have been stressed for a while, and We've been talking about it for a long time. We
Yes,
know
we
the
have.
cost of living has gone up incredibly fast. Doesn't seem to be subsiding. You get the new inflation numbers and they say, oh, well, it's only up 2%. That's stacked on top of the other.
That's right. 4/10 of a
80%.
percent, no big deal.
Yeah. But wages have not kept up. I do understand some wages have gone up and this and that, but nowhere near have kept up with what it costs to live. And it does stress people out. Doesn't stress everybody out, John, right? It's a certain section of the economy, but I think it's a big enough section of the economy that it bears.
It's a section that spends the most.
Yes, and it's a section that can fall behind the quickest, and so it's something to be aware of because it's pressing.
There's even some data, we're not going to get into it tonight. There's even some data out there, Corey, that the higher end, I mean, the multimillionaires, the billionaires even have pulled back some of their discretionary spending.
Sure. Well, and if you think about it, not to get into the nuts and bolts, but I don't want to sound like a complete jerk, but the higher end people usually own the companies that make the widgets.
Yes.
And the people down here have to buy them. So if these people don't buy them, these billionaires don't get their money.
There
And
you
so
go.
they can kind of see how the wheel spins.
Yeah,
That's how
that's a
money's
great
created.
analogy.
There's a 5 second education on how money's created. So
See, folks, that's all you got to know about economics. That's right.
be the person that makes the widget.
Yeah, that's right.
the
That's
lesson.
right.
But
Exactly.
I'm sure they see it in their bottom line and say, oh, things are slowing down a little bit.
Yeah. Oh, yeah. No, that's when they pull back. And I love your last bullet point under this subject, which is the psychological shift from spend to survive. Right. That's really what it's gone to. Like I said earlier, discretionary side of it's gone. It's like I'm just surviving. I'm trying to put food on the table and so on and
And
so
you're
forth.
one big car repair bill away, sewer
Yes.
line replacement, roof. You're one big expense away because a lot of these credit cards are close to maxed out,
Hmm.
close enough that if you get a big expense, and I don't know, that's relative, but 5 grand, 10 grand, something that's big to people, they don't have the cash and then they don't have the spending ability. And then the cascading starts and it
Absolutely.
becomes a big issue.
Let's go to our fourth point, making the real estate decision basically under stress. Talk to
Yeah.
us about that.
And so I think a lot of this, we talked about a little bit on Tuesday about distress and this and that. I do think that a lot of sellers are perfectly content right now. Their Zillow app says their house is worth X. Some of them maybe have converted some of that equity with an equity line, so they're using it. A lot of them are happy just to see the cushion there. It makes them feel good, even if they could never convert it. But I talked to so many different clients who are like, man, my payment is $1,200. My payment is,
Yeah.
why would I ever move? And they're right. And so I do think there's a lot of that. And buyers feel stressed because they can't get in on it unless they pay a super high price. But that's the economy. I mean, it sucks, but that's kind of where we're at.
You yourself and your partners and your clientele, you deal with a lot of investment properties. What's going on with that segment of the real estate population?
So I think rents hit a point, and I'm probably going to get proven wrong here, but I think rents hit a point where they have plateaued as well. They're not coming down, but they're not going up as fast as they were. And so now when we look at something and you want to underwrite it, it's like, okay, I can't mark in a 10 or 15% increase in the rents in the 2 years it's going to take to build this. And oh, by the way, it's going to cost me 8 to 10% for money to build it. I was reading an article the other day locally of all the affordable housing projects that are being built here now. And they get subsidized by the Fed, so they get cheap money. They have to qualify with certain things. So I still think it's a healthy market, John. People still need a place to live, but it's certainly not as gangbusters as it was.
Right, right. Along the lines of the more of the kind of the high end real estate client, what are smart consumers doing right now, in your opinion?
They're shopping. I had a long discussion with a very good client of mine, friend of mine today, and we were talking about a house that he was purchasing. And it just kind of boiled down to, could you afford it? Of course you can afford it. And so to me, and I've said this for years, then it boils down to the human side of it and the emotional side of it. Do you like the house? This will probably be your last house. This is probably going to be you know what I mean? It's not so much that it's a financial decision because most of the people I deal with in that range, they can afford the house. That's not the issue. It's in that range, they always want to negotiate and they always want to get the last penny
Mm-hmm.
on their side, which isn't the worst thing. But then when you step back and say, well, you know what, there's more. Like, what is the value of not having to look anymore, of knowing I'm going to be secure for the next 20
Right.
years in this property, like, all those things. And so then I think that kind of tips the scales of moving forward with the purchases.
All right. Makes perfect sense. All right. When we come back, Corey's got to step aside. He's got to head over the hill. But I'm going to be talking about the wealth divide, why some owners are thriving, why others are struggling. Kind of break that down a little bit further as we continue our discussion on what your financial health means for the real estate. Mr. Edge, have a safe trip and a great
Thanks, sir.
practice. All right, buddy.
All right.
See you on Tuesday. All right, let's turn it over to Kristen Snow right now, Traffic Center. Welcome back to the Jon Sanchez Show on News Talk 780 KOH. Once again, we finished down 669 on the Dow. NASDAQ lost 469. S&P down 108. No specific news behind it. It was a rotation. We'll see if it's going to continue or maybe subside a little bit. Had a couple opportunities today where the buyers started to step in and sellers definitely dominated, obviously. So I just checked the futures. They're barely budging at this point, which can be viewed actually as a good thing. I mean, there's a lot of beaten up names right now that are on sale. And so you get into these these situations, as I said many times on my stock updates this morning, either one or two things are going to happen. Either the algorithms specifically, because this was so algo driven today, they're either going to continue to drive this down to certain support levels, certain technical factors of the market, or they're going to step in and go, okay, this stock is down 10%, this one's down 20% from its highs. Let's step in and start nibbling, and then that's how you get the snapback rally. Nothing has changed as far as AI. Nothing has changed as far as spending. This is all in the eyes of the beholder and what they think is expensive, what they think is cheap, and so on and so forth. So would not recommend any major changes to your portfolio as of yet, right? But again, as we discussed on the show yesterday, it's all about having a diversified portfolio. That's how you survive these type of short-term shocks like we're experiencing right now. All right, with Corey and Dwight, we've been talking about what your financial health means for the real estate side. And I want to talk a little bit about the wealth divide in housing, right? So the wealth divide is something, of course, we experience in all aspects of our economy. You've got what I call the K graph, I guess is the best way to look at it, right? So if you can picture the letter K, that graph that goes to the vertical line to upper right, that's the wealthy, the upper middle class, the top 1%, whatever you want to call them. The bottom leg of the K, that's everybody else. And if you notice with a K, there's nothing in the middle, meaning that middle class is getting squeezed. Either they're getting job promotions and growing, and they find themselves in that upper leg of the K, or maybe they lost their job to AI or whatever the case is, and they fall into that other area. There's a lot that's not in between. And so I want to kind of wrap the show up with a really fascinating article that we came across from Market Watch. And listen to some of these stats, folks, as I wrap up the show. Between the start and end of 2025, there was a 60% jump in the number of homeowners in negative equity situation. 1 in 10 homeowners were underwater on their mortgage in 2025 in some cities in Florida, the new data shows. About 1.1 million American homeowners were underwater on their mortgages at the end of last year as home prices stalled, signaling a deepening crisis within the housing market. This figure represents 2.1% of all mortgage borrowers in the U.S. Though the share may seem small in context of the overall market, it's also the largest that we have seen since 2018, and it's also up nearly 60% from 696,000 at the start of last year, making a significant jump. And of course, homeowners considered to be underwater on their mortgage when they owe more than what the home would sell for. In addition to the 1.1 million people underwater, an additional 3.2 million borrowers, or 7.9% of the overall population, have less than 10% equity in their homes, according to data released by Intercontinental Exchange, better known as ICE, just on Monday. Why are 1.1 million mortgages underwater? Well, this is really interesting because so many people bought in 2022, which they were in good shape, right? That's when rates are low. But those that have bought from 2023 up until pretty much the present, they have very little equity, if any, or maybe, as the data shows, some negative equity. Why? Because they got into a high 6 or 7 or high 7 mortgage rate. And so they're just not able to, the values are not going up because, remember, real estate goes up for a number of reasons. One primary reason is they always use the domino theory, right? You buy a starter house for, I don't know, pick a number, $500,000. You live in it for 2 or 3 years. It goes up, say, $100,000. You then sell that and you go into the $700,000 house. And then someone steps in and bought your house and you just bought someone else's and they probably moved up the chain. That's that whole domino theory. But if one of those dominoes in the chain don't sell, don't move, guess what? The rest of the dominoes don't move either. So that's the way you have to kind of look at this. Some of the areas, by the way, there are luckily nothing here in the West Coast that are getting hit, mainly Florida, Austin, Texas, but a lot in Florida. And as the boys and I were discussing at the break at the bottom of the hour, these are areas, of course, where we saw a significant population boom, right? All these people moved into there. They gobbled at the homes when rates were higher. And now they're sitting at, basically negative or no equity situation or flat equity situation. Nationally, home prices last year only up 0.6%. That was the smallest gain that we have seen since 2011. Cape Coral, Florida saw the biggest drop in home prices last year, followed by Northport, Florida, and Austin, Texas. Austin one worries me because there's a lot of people that moved, especially from California to Austin. Let's see, 3 markets were underwater mortgages are most common: Lakeland, Florida, Cape Coral, Florida, again in Austin, Texas. Let's see, any other steps? Coming into this year, homeowners held nearly $17 trillion in equity overall. So there's the bright side, according to ICE, said with just under $1.1 trillion considered tappable, meaning the homeowner can borrow that amount against the property value while still maintaining a 20% equity situation. So now that's the old adage, asset rich, cash poor, right? Let me repeat that stat. $17 trillion in real estate equity, 11 trillion considered tappable. So obviously that means we have 6 trillion that you can't get your hands on because of the value of the home. It's an interesting situation. We don't see any problems at this point. Still highly recommend real estate as part of a diversified portfolio. But again, just things you need to be careful about. Make sure, again, your job is stable, et cetera, before getting that mortgage and or an investment property, because things can turn very, very quick. All right. That does it for me. God bless. Have a great afternoon. We'll do it again tomorrow on the Jon Sanchez Show. News Talk 780 KOH. Take care.
Dwight Millard, NMLS ID number 241259, a licensed mortgage loan officer with Highlands Residential Mortgage Limited and Equal Housing Lender. NMLS ID number 134871. The information shared on this live broadcast is for general information purposes only and does not constitute financial or mortgage advice. Listeners should consult directly with a licensed mortgage professional for guidance tailored to their specific situation. All loans are subject to credit approval and program guidelines. Not all applicants will qualify. Loan terms and availability may vary by state and are subject to change without notice. Highlands Residential Mortgage Limited is licensed in multiple states. For a full list of state licenses and disclosures, please visit https://www.highlandsmortgage.com/licenses/. The views expressed during this program are their own and do not necessarily reflect those of Highlands Residential Mortgage Limited. Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.